Hi guys, welcome back to the channel. Today we're talking about covered calls and when we sold one, when it's time to close one. So if that's what you're looking for, please stick around. Whoop! There's a cat in the background. Now we buy stock for only one reason, that's to make money, but we do sell them for lots and lots of reasons. That's how the saying goes. And the same is true of a covered call strategy. So if you decide to sell a covered call, you should have a strategy behind this and a reason that you're doing it in the first place. Is it to generate the maximum premium that you can, or is it to generate some premium, but hopefully keep the stock because you're trying to limp towards that 1 year holding period where you have that tax advantage of having it for over 1 year. Or maybe it's the next dividend date that's coming up and you want to make sure you get over past that point. Or maybe you think it's overvalued at this point. The stock's just worth, it's gone up so much, you're willing to get rid of it now because you think it's truly overvalued. Or maybe you just want the money off the table because you want to invest in something else because Bitcoin has dropped so much. Whatever your reason is, I want you to understand that you should have a reason behind this, and you should understand that a covered call strategy does limit your profit potential. You're going to reduce your ceiling. It could go flying through that ceiling. You could lose a lot of money. So understand that first, because you want to make sure this all makes sense in the first place before you can start talking about how we're going to close them. All right, so once you have that reason in place, we're going to go sell our covered call, right? And we're going to do it on stock XYZ, the most popular stock in the world when it comes to options trading, apparently. So stock XYZ is at 100, right? And you've accumulated 100 shares over time, right? You either got them put to you, you bought them over a period of time, or you just bought 100 shares. You've got them there, and the stock's trading now at $100 a share. So you being the crafty person that you are, you go out and you sell the $105 call option. Sell to open one contract, right? 100 shares. And that's out 30 days till expiration, right? That's our setup. Everybody with me, right? And for that, you get to collect a premium, right? And that premium, let's say it's $110. So you take that $110 and you stick it in your pocket. You get the sushi guy on speed dial, high five yourself. We're off and we're running, right? Everything's working just perfectly right so far. So time starts ticking away. And first we have scenario one, where the stock price starts to go lower, right? It was at 100, and after 1 week it goes to 95, 2 weeks to 93, 3 weeks to 92. Look at the premium, the price to close it out, buy to close, and it says $10 now. So remember, you collected 110, it's only going to cost you $10 to close it out. Would I do it? Yes, absolutely. I'd get out of it. I'd take my net $100 because that last week, I consider it dangerous, right? The stock could come roaring back, and then I'm put to a decision on what to do. But if I get out of it now, it starts to come roaring back. Well, that's when I can sell to open another contract, right? Another covered call, and I will have a nice premium again because it came roaring back. But if I don't close out of that, then I don't have that option. So in this case, you buy to close, you get out of it, you take your nice little net proceeds there, and you decide your next move. And here's an example using WYNN Resorts. This is a $100 call option that expires about 10 days from now. And I collected $152.64 when I initially sold these two call options. And with WYNN trading right now at $85.80, this is only going to cost me $14 to close right now. So I would keep the majority of that premium, and I can sell, or I can roll this out. I can sell it out further and collect a larger premium going forward. Or I can wait a little while for the stock to rebound to some. You have choices here, but there's no reason to leave this lingering out there at $14 to close it. Close it, reposition. Scenario number two is when the stock just kind of trades sideways. Week 1, week 2, week 3 goes back, and it's still right around that $100 per share, and you've got the $105 strike. And it's kind of hard to close it out until you really get close to expiration, right? There's still built-in extrinsic value, right? Theta, time, and IV is still in there enough that it's hard for you to effectively close it. So you got $110, but you're still looking at this thing that's worth 40 bucks going into the last week. Some people might close it out. I would probably continue to try to collect that last week, maybe down to that last day or two, and then I would look maybe to roll it out again and sell that $105 strike price again. But in general, you're gonna probably want to wait as long as you can and feel safe and comfortable in that trade. Now, I see this a lot, and these are some great trades. I've been doing this with Morgan Stanley recently on a couple hundred shares, and I just continue to churn these because Morgan Stanley's kind of just stayed in that little pattern. And I've done great, whereas I look at my core holdings, and I've got Morgan Stanley over there, and I'm collecting that little 2.8% dividend. That's it. But in my options trading account, it's really kicking butt because I keep rolling these options, collecting lots of premium. So these can be really effective trades if you can find stocks that are kind of just staying in that little area over a long period of time. So in this example, Corsair Gaming, which is trading at $20.57, has just kind of been moving sideways on me for a while. and I've got a $22.50 call out there about 10 days from now. So since it's at $20.57 right now, that's about 10% below my current strike price. And I collected $202 initially, and now it's worth about $40 if I wanted to buy to close. So I'm probably going to drag my feet on this one a little bit and wait till next week sometimes, because my feeling on Corsair is I'd like to get rid of this actually and hopefully buy back at a lower price. So that's the situation with this one, and I'm just going to kind of see how it plays out for a few more days before I decide what to do. The third scenario is a great one. It's when your price of the stock is trending right towards your strike price near expiration. So we've got a $105 strike price out 30 days. It's right headed towards that, because this is the scenario where you've collected all of the premium and you've got the stock appreciating from 100 to 105. So you put that extra $500 in your pocket from the stock going up in value. So in this case, you're doing great. You made $610. You've got an option now. Has your thesis changed from when you originally decided to sell this call in the first place? If it hasn't, well, then you're going to roll it out, probably is what I would do. Roll it out to $105 again. A few weeks out, I'd collect a nice big premium, probably another $500 there. I'd be feeling great about this trade. Now, if you want to get greedy and go for a $107 strike, you could probably roll it out and collect a nice big premium that way too. If you really want to get rid of it, you could even roll it back down to 104 or 103 if you know you want to get rid of it, and collect the built-in intrinsic value when you do that, if the math makes sense. So you got to figure that out when you're going to do that. But in general, you're in the driver's seat at this point, and you can decide what to do. So that's like the perfect scenario that we would have when we sell a covered call. In this example, we have Cardinal Health, and it's currently at $51.68, and I have a $52 call on 4 contracts expiring in 2 days. So it's decision time, right? We're very close to the strike price, and Cardinal Health has been all over the map this week. So I'm definitely going to be closing this out on Friday, and I'll be rolling it out to a further expiration and keeping the stock. I just don't know where it's going to be on Friday. Could it be at 51, 52, 53, 54? I don't really know, but if I can, I'm going to roll it out and roll it up. But I'm definitely going to try to keep the stock, close it out, even though it's going to cost me $160, and I only collected $113 initially. It makes sense to me to close it out and roll it up. I'll be able to collect a lot more than $160 when I roll this out if it's right around that $52 strike price. And the final scenario is when this thing just shoots through the roof, and it does happen. It just happened to me with Micron. I did a little video about it. I'll link it above if you want to watch that one. Happened to another guy that I was talking with on here. He had Ford stock, sold the call, and of course it went up about 12 or 13% over the next couple of days. So it does happen. Shoots right through that strike price. So how do we handle it in that situation? Well, my typical scenario is I let it go. I just let it disappear and walk away from me, because as it travels past that strike price, right? So it's at 100, goes to 105, and maybe at expiration it's up to 108, right? So I'm on Friday, I'm watching the market at 3:45 p.m. and I'm looking at it. I'm saying, okay, I could buy to close, and it would cost me maybe $310. Why $310? Because it's got $3 between 105 and 108. $3 of intrinsic value, but the extrinsic value is pretty much nothing now. So it cost me about $310 to close it. So if I were to buy to close, I would have to pay $310. And I got $110 when I originally sold it. So I lost $200 on the trade. But my stock that I sold, when I sold it, was worth $100, and now it's up to $108. So I got $800 there. I lost $200 on the trade. So my basis changed, right? My basis is increased by $200. So as long as you understand that, you can decide if you want to buy to close this, because you have the value now. You just lost on the trade, right? So you have to decide on Monday, is this thing going up or is it going to go down? So the reason I would buy to close is if I had a faith that all these bank stocks are going up higher, and I'm going to buy it and keep it. But in general, I'm going to let them get called away. It's really up to you and how you feel about the stock, right? Do you want to keep it because the next dividend date's coming up? Do you want to keep it because you've owned it for 1 year then, and you're going to pay less tax on it when you sell it? Those would be good reasons to consider keeping it. So it just depends on the scenario. But in general, that's the mathematics and how I walk through it and take a look and decide, do I want to keep the stock? So in this example, we have Intel, one of my favorite stocks right now. I think going forward a few years from now, Intel is going to be a great long-term hold in. I am long Intel. I've got plenty of shares. But with these shares, I'm buying and selling, and I'm kind of working around earnings. So earnings are coming up, and Intel has not been, earnings have not been kind to Intel, let's put it that way. So what you're looking at here is I've got a $53 call that expires in 2 days. Stock's already at $55.74, so I'm probably going to lose it, right? I only collected $85 when I sold this in the first place, so I didn't play it really that well because now it would cost me $560 to close it. But I could do that if I was long Intel with these shares. If I wanted to keep Intel, now I could still pay to close that and roll it out. So if I was really wanted to keep it, I would do that. It makes sense if you work through the math, but in this case, I want to let those shares go because I'm hoping that when earnings come out, it gets clobbered like it usually does. I'll be able to pick up the shares again, probably buy them outright, and immediately start selling the covered calls again with this particular money. That just works out really well for me because they also pay that dividend right after earnings. So I've been able to work this for quite a while, and it's always paid off. But that's my feeling on Intel. But you always have to think through it. Does it make sense? Do you want to keep it? Do you want to let it, or do you want to let it go? And I should add, another strategy that I really like to do is just to roll this call out as a $53 call. So buy to close and roll it out to a further date because at $53 a share, I'm still going to be able to collect a nice premium. And then we can see what happens during earnings. But with the number of shares that I had, I kind of want to let these go. Plus, I have a $51 call, and I'm hoping that with earnings, it really gets hammered, and I can pick them up again at that lower price. So we're kind of see. But if you do roll that out, just remember you get to maintain that date you acquired those shares, and you might be able to reach tax benefits where you hold these for over a year. So something to keep in mind and another great strategy to use. I like to use the covered call strategy to add some additional income to my portfolio. In certain markets, it works exceptionally well. In other markets, it really does limit your profit potential. So look for opportunities and try to understand when it's a good time to close these things out. Now, if you have any questions at all, please ask down below. I'd love it if you would like and subscribe. See you next time. Have a great night. Take care. Whoop.